Welcome everybody, my name is Ture Østergaard with HC Andersen Capital. It's a pleasure for me to welcome you to this Q4 investor presentation with Hafnia Limited, and especially a warm welcome to you, Michael Skov, the CEO. We have ahead of us approximately 30 minutes. You are very welcome to ask any question you may have. I'll try and ask them as quickly as possible. You can see everything on the right hand side. You can see all the questions that's already been put in, and you can ask your own questions. But welcome, Michael. It's a pleasure to have you.
Thank you.
And it's not that long ago since we spoke last, and now Q4 is in the back, and you are above $1 billion in EBITDA. It must have been quite a year.
Oh, absolutely. And as you say, I mean, it's been one of the strongest years ever, actually, for us as a product tanker company, but also in comparison of any others over the years. So for sure, last year will go in history books as probably one of the strongest years that we've ever seen so far. So very happy with that for sure.
Perfect. Let's get into it. We have a sort of agenda of we'll try to tailor it for everybody's needs. But let's just do the brief introduction to Hafnia here, please, Michael.
Yes, so thank you for that. So Hafnia is all about transportation of refined oil products. So we own and operate product tankers. As you can see from the top of the slide, we financially own and financially control 128 vessels, but we actually operate because we have pools where third-party owners give us the commercial control. So our market share is around 240 vessels that we on a daily basis operate globally worldwide. The average of our own fleet of the age is 7.9 years, as you can see on the left side as well. And you should see that in the context of the whole fleet in the product tanker market, probably being around 11 years, slightly above at the moment. So our fleet is young, which basically gives us a much longer path in terms of earning capability versus the average of the market in general. That's on the left side. We're obviously listed on the Oslo Stock Exchange. If you look a little bit on the right side, and I'll come in on a few of these items afterwards. But top right, we use the term active management, and the background of that is really just to illustrate that the story and the DNA of Hafnia is very much around having done acquisitions, mergers, etc., and grown the company that way. Which we think is an important part of how you built the business. And I only say this because obviously at the moment when the market is great, everybody makes a lot of money, but the focus with us is to continuously look at how do you develop and how do you push the business further. We are the largest operator in the world of product tankers and chemical tankers. And on the dividend side, we have introduced a dividend policy end of last year, which is based on our net loan to value. And that has meant that from last year to this year, we are now paying for the last quarter last year 60% in dividend, which is 10% off from what it has been before that. Finally, I think on the earnings potential, we'll get into that a little bit later. ESG is an integral, strong part of our whole DNA as well, and strong focus these days also on the environmental part of the business, which is a big challenge for shipping in general. How do you reduce your environmental footprint in terms of emissions as you go forward?
Thank you for that introduction, Michael. The only thing I wanted to ask here was the 7.9 years. How is that actually in comparison with your competitors?
Yeah, so as I mentioned, so for the average product tanker fleet is today around 11 years and a bit. So that does tell you in a way also that when we talk about the fleet overall going forward, the world fleet is getting older. And that's also one of the reasons why a lot of people are positive in this segment is that there's quite a lot of scrapping coming up the next few years, which will again reduce the supply of available vessels.
Let's go into that a little bit later. Perhaps just a few words on this, on shareholders' returns. Of course, it's been a fantastic year for you with the earnings development. I get some questions sometimes whether you actually prioritize dividend over payment of debt because of the interest rates going up. It's a natural question. If you want to, continue to do dividends rather than pay down your debt, or alternatively buy back shares?
Yeah, which I think is a totally fair question, and there's a couple of things that we take into account. I mean, so first of all, I should probably say it's not carved in stone. This is a debate that we have every time and every quarter with the board. Should we buy back shares versus dividend? But in terms of debt, we do both. So basically, we basically pay down debt at the same time as we pay out dividend. We were fortunate enough that Hafnia had a very strong balance sheet even before this market came. So we have not, if you like, had any over leverage of the balance sheet. So we've been able to kind of manage both as we go along. We have had the most competitive finance cost of all of our peers. So what that means also is that we'll have an ongoing reduction of the debt. We took over some expensive debt when we bought CTI very early last year, and all of that debt is now being refinanced to come down to normal levels. So we do both, but we do debate as we go forward whether there's at some point we'll buy back shares versus dividend. But a very important part, and one of the reasons why I think also when you look at the liquidity of the Hafnia shares, is that it's been very important to get that liquidity up, and we worked all last year on getting the liquidity up, and we see how much it means. So we are a bit reluctant to start buying back too many shares, and therefore push that liquidity down again. So it's that balance we try to manage.
Yeah, and basically you changed your sort of dividend policy through 2022, and you will now be paying 60%, I guess, of Q4. When do you actually get those money?
What do you mean when they get paid?
Yeah, exactly. What is the dividend?
Yeah, so I think we go ex-dividend on Friday, and from my memory, I think that dividend paid is a week later, I think, or maybe 10 days.
Okay.
But we go ex-dividend this coming Friday.
Okay, fair enough.
And just to mention, the dividend policy is very much linked to the net LTV, as I mentioned, right? So basically, as we go along, as we reduce the net LTV, we'll be increasing the dividend at the same time. So basically, below 20% net LTV, the dividend will then go up further, and below 30%, the dividend goes to 70%. So that's kind of the logic behind it.
Perfect. Should we just do perhaps a little bit on the fleet coverage? I guess most people have seen your numbers for 22 by now, so it's more interesting to take a look at sort of the fleet coverage going into 23.
Yes. So I think the important point about this slide is basically also to understand one thing about last year. So last year was a record year on earnings, but first quarter last year was actually not particularly strong. So if you look at the fleet coverage slide and you look at the gray part of the slide, that illustrates what we made last year in Q1 2022. And if you then look at the green one on the right side, shows you what we have covered so far for Q1 2023. So I think it's a good illustration of that. Markets have improved, and we had a good year last year, but this year is off to a much stronger year than what we saw last year. So that's kind of I think the main takeaway from it. And if you look at the earnings that we've covered so far, we've already covered 71% at $36,000 per day. So that's significantly up from last year.
Yeah. So, and just to be clear, the 71% is for Q1, and the 27 is for the full year of 23.
That's correct. And that's a combination of longer term contracts, and it's a combination of shorter term contracts that we've done already in the first quarter this year.
Cool. And just, maybe stating the obvious, but on the chemical MRs, it's a 91% coverage for Q1. Is there any, it's actually very funny to see the differences here.
Yeah, so and that basically is because that some of the chemical ships and the actual chemical market has slightly longer contracts, even for spot markets. So you kind of conclude your commitments a bit further out than you do with refined oil. But the interesting part of the chemicals versus the product tankers is, of course, that you should see them as a combination, right? So basically, technically, these are the same ships when they were built. The only difference is that the chemical vessels can carry more aggressive cargoes than the standard product tanker. But we run them in parallel, so the real value that we have seen is actually that we gain from both segments by having them both. So it's about triangulation, and sometimes chemical ships move in and take a clean product tanker cargo because it makes sense. And that's kind of the whole synergy that we were hoping to get from buying that fleet. And that has really, been unfolding in a very, very strong way so far last year and also the beginning of this year.
Perfect. Let's continue. I like this slide. It's you are not guiding the market, and I've asked you a couple of times why are you actually not guiding, and maybe you're considering it, but you do this slide.
Yeah, exactly. No, exactly, and I think there's a lot. I mean, there's a lot of good reasons for that. I mean, we have been debating it. You can guide, and sometimes it's good. Sometimes you also, if you have volatility, etc., in the market, it may or may not be such a good idea. What we do is though that we do have very close discussions with the analysts that are covering Hafnia, and to make sure that when it's possible that they understand exactly where we are. So this slide is really meant as as an earnings guidance in the sense that you have a consensus of what analysts are saying at the moment, basis their own forecast. Then you have afterwards the potential net profit for 2023 if rates continue as what we have covered for Q1, and then you finally have on the right side estimated net profit of the 1.4 billion, which means that if the freight rates that we've seen the last week continue for the rest of the year, then that will be the end result for Hafnia. So what that gives you is at least also, and I think this is important, a good understanding of, with the volatility that we have in our markets, there is a bit of uncertainty where things can go, but the interesting part is that the bottom levels have gone up quite dramatically when you compare analyst and consensus versus where spot markets are.
And for me, it's always interesting to check out what is actually the market cap of the company, and that's approximately $3 billion, right? So that puts 1.6 billion into context. I think that was just my reflection on the slide.
Yeah, I think that's right, and I think that is that is something that the shipping industry has been, I think, dealing with for many years. Is that because of the volatility, you have never really had the full value in your share price based on many years of forward earnings. And possibly, at least from our point of view, we're going into a phase now where we think that there's a very, very strong argument for that you're going to see strong earnings, still with volatility, for the next many years. And I think that's, in a way what we're trying to explain to the markets, that with that length, actually, you should reflect more of that value into the share price. Right now, we're not getting a lot of value into the share price compared to earnings like this continuing just for 12 months out.
Fair enough. If you have any questions, please ask them in the chat. Let's go into the industry again. I don't know if you want to put a few words on the demand side here.
Yes, so I think for us, the demand side is driven by two things. It's driven on one side by absolute oil demand. And if I compare, this conversation we're having now to the last time that we had a conversation about Q3, what has happened on the demand side is that China has suddenly reversed their COVID-19 policy, and therefore oil demand is now estimated up by all consensus energy agencies to even go beyond 2019 levels already this year. So what this has meant is that the fundamental demand is coming back up rapidly. But what's more important also is that, as you see on this slide, is that the ton mile is coming up, which basically means that our ships are sailing longer with cargoes. So some of that was already happening over many years, but we have obviously seen an acceleration of this as a lot of oil that used to move from Russia into Europe, i.e. short-term voyages, are now being replaced by longer-term voyages. So we're simply seeing a structural change, which means that ships are sailing longer at the same time as absolute demand is going up. So that's one side. The reason we have the other one on dirty petroleum graph with as well is just to, in a way, to make everyone realize that when we look at the product tanker market on an isolated basis, there's really no sector-specific issues that draws that market potentially down again. What could be a potential reason sometimes is if the dirty market that we're illustrating here is very weak, that you see some cannibalism, that some of those ships will go into our market and therefore take away, potential cargoes. That dirty market now is also showing improvement. The ton mile, again, the strength of the market The longer distances are going up. The crude market is super strong as we speak. And the crude market is very much driven by China as well. So with China coming back, you're seeing that unfolding right now. So that means you've taken out, again, a very important parameter is that as crude market is strong, it also means that we're not going to get any tonnage in that can ruin the clean market.
And then perhaps let's discuss Russia. It's very difficult to get more solid information about what's going on. But I think you've done a count here in sort of the shadow market and the shadow fleet here. Maybe you elaborate a little bit on this.
Yeah. So basically, so what happened now after the 5th of February is that you now had the sanctions on Russian oil in force, which basically means that oil can only be lifted and traded into the open world if it's under a price cap agreement. Russia has clearly stated that they will not sell any oil under that price cap. So we're already seeing, basically a resistancy that means that whatever you track of loading out of Russia is most likely going to be in violation of sanctions. So what we have done is that we have tried to illustrate here, measured on IMO numbers. That is basically you use the data that's available where ships are under their tracking systems, so you can see what has actually gone in and out of Russia. And as you can see here in the clean sector on the left side, we've already seen 190 ships been calling Russia, loading Russian oil, and on the right side, 286 ships on dirty. So what that basically means is suddenly that all of these ships, or at least a big part of them, will most likely not come back into the open trade again. So this comes a little bit on top of older ships scrapping, negative fleet growth, but on top now we are seeing is that a lot of these ships that are now trading and violating sanctions will not come back. We have several oil companies in the world that are basically stating that if they can go back and see that your ship has been loading in Russia, it doesn't matter how long ago after the sanctions took place, they will never take her again. So it's a very important thing. It's obviously still early days, and these numbers will probably only grow, but it's just to show the world as an illustration that we again seeing a positive side on the supply side. The ships are disappearing as available vessels for the normal market.
Thank you. Very interesting slide, I would argue. Let's go into the rest of the supply market. And we've done these speakings for quite some time, and to be honest, it's amazing that the number of ships is not increasing with the rates you see. And you pointed many times that it's because it's not possible. Is that still the case?
Yeah, and I do think that's an important argument, because I know that a lot of investors have had really bad experiences with shipping over the years, where basically the minute we make money, we go on, we buy a lot of new ships, and we basically destroy the market afterwards. And I will not be the one sitting here and saying that it couldn't have happened again, because most likely it would have. But the reality now is that it cannot be done, because shipyards basically filled up the space earlier with gas carriers, with container ships, with offshore units, anything but product tankers. So as we started to make money, even when you looked at new builds, that train had already left the station. And the earliest you can get something is now late 2025, early 2026. As you can see on this slide very well, you see the prices have gone up dramatically for new build. So you're technically in a situation where we as a ship owner, we want to buy a new ship, we think it makes sense. We can only get it in 2026. We're, by the way, paying 25% higher prices than historical averages for these type of ships. And we're buying a conventional vessel that is not even adaptable to a world of renewables. So that's a very hard sell for any board or any investors to find the logic in that, which is why we're not doing it. So, to put this a little bit in perspective, what we are saying here on the right side is that including 2025 and taking into account scrapping of ships when they become 25 years old, we only see a net addition of 35 equivalent medium range tankers. That should be seen in context to average years, not 3-year period as we're talking about here, average years of 100 to 150 vessels being delivered every year on average years. So it's a huge difference. And in our view, we are seeing what is unfolding in the tanker industry, very similar to what you saw in oil production and offshore industry, that we have now underinvested for 3 years. And that basically means even if we start to order ships for 2026, as you approach 2026, you'll be scrapping a lot more ships than you can deliver, even if you fill up the order books. So this underinvestment is now in a way becoming the positive factor for, we think, for many, many years of stronger market. Even if we want to, we're not going to be able to order so many new ships for 26, 27, that they can cover the shortfall of what will be scrapped during those years.
I guess normally, being an observer of the shipping industry, the negative surprise here could come from the less of scrapping. That there will be less scrapping that you originally estimated, simply because of the rates. I don't know if that's a fair argument in the product tank industry.
No, I think that's a fair argument, but then I see that but that's only because the market is so strong, right? So the reality is it's not going to ruin the market, because if the market at some point start to drop a bit, those ships will get forced out immediately. So it's almost like, it will drag it out maybe a few years, but eventually those ships will have to go. And we should all bear in mind that the current environmental regulations that are now coming into place are making it very, very difficult for old ships to stay in the business. You have to show progress every year that you're reducing your emissions. So it's going to be expensive and difficult to run these old ships in the future.
So to sum it up, the historical lows of less than 5% in terms of total order book is still standing.
Yes.
Cool. Let's do the next one here. The only question I have here, Michael, is that this is sort of the freight rates over time, and in January, early January, we got ourselves a little surprise. It suddenly fell drastically, and it immediately spurs the risk-averse investors say, okay, is it over now?
Yeah.
Do you have any explanation for that sudden drop you saw in early Jan?
It was probably a combination of a few things, right? December was a very active month. And there's no doubt that there was a lot of the activity in December that basically took away some activity in January. That being said, obviously you have holidays, you have Chinese New Year coming. So the fact that January is slow is actually not a surprise. When we go back 10 years and we look at January, basically January has always been the lowest month in terms of activity compared to the month of December before and the month of February thereafter. So there is a natural seasonality in it, and I think, I think for investors in general, they need to get used to the volatility, because we think it will continue to be there. The only difference is that the floor levels will consistently stay higher, and that's the main thing. And that's why I think it's a bit dangerous to sit looking at weekly rates. Oh, the market is now 50,000, now 30,000, and people start changing their mind. I think fundamentally, we're looking at a very, very strong year and years ahead of us, but we're still going to see some seasonality. And quite frankly, the US Gulf last week was a very good example. I think on a Friday, when we kind of left the market, it was around $10,000, $15,000 for an MR ship. And by the closing of Monday, the next working day, the market was $45,000 per day. So it doesn't take weeks to get it back up again.
Okay, fair enough. But I guess on the left-hand side here, you have the oil. This is the demand and supply curve. I guess you are going into and you're trying to position Hafnia in. And I think it's always a surprise to many investors how much the oil demand is actually growing still, no matter how much we try to change the world.
Yeah. Well, I think it's all, and I think it's been a surprise to, as you say, to all of us. And there's no doubt as we kind of entered the period of COVID-19 and the dramatic drop in oil demand when kind of everything was at a standstill, in combination with the whole environmental debate, I think that's at least our view is that there was probably a lack of understanding of timing in terms of getting into this environmental transition. And I think this has probably been, or most likely been, one of the main reasons why people didn't buy any ships or invested in anything, was that everyone expected that transition to happen earlier. And what we are seeing now is, of course, that the world is still in need of oil as an energy source, and If anything, actually, the demand numbers have been revised upwards quite a lot, not just for this year, but actually also for this decade going out.
Fair enough. Let's just sum it up. I guess it's always the ESG we are ending with. You're actually talking a lot about ESG in the shipping business, and particularly in Hafnia, I think. Maybe you could just sum up why you're actually so active on this.
Well, first of all, I think it's because that we'd like to be seen as a company that takes these things seriously. And I'm not just talking about the environmental part. I'm also talking about the social part for S. The governance part follows pretty well the fact that you are stock listed, which means you should be totally transparent, which we are. So that's almost a given as a license to operate. Yes, but I think on the environmental and the social part, these are important things for us. And quite frankly, we also see it as a competitive differentiator for us. A modern fleet being ahead of initiatives that will reduce your emissions. So I think if you look at the left side, and I'm not going to go through all of them, but just so people have a little bit of an understanding, what can you actually do on your existing assets? So, I mean, Hafnia's view is that we try not to talk too much about 2050. We have a climate strategy. We have an ambition where we want to get to, but we try to focus on what we can do today and making the ships more environmentally friendly tomorrow. And on the left side is a list of initiatives that we are implementing in our fleet. And on the right side, top right, you can see the percentage effect it has on the CO2 emissions by doing this. So it's just to put it a little bit into perspective that on the left side, if you do, as we have done on a lot of ships, these different initiatives, you can obtain up to 15%, as you can see top right, 15% of savings in the first year that after you have installed everything. So basically what that means is you come out of dry dock and you are a ship that's ready to trade for a number of years. You get full value of these initiatives from day one. It's about 15%. So there are actually meaningful things you can do with your existing business to keep ships alive and extend the lifetime of the current assets that you have. And we think, as being underinvested, as we just spoke about, in the need for more ships, we think this part is very important. The owners and the businesses that are able to extract more life out of the existing assets are the ones that will fare the best going forward, as there will be even more demand for modern tankers as the older ones, as we just spoke about, are being phased out.
Thank you, Michael. If there's any pending questions, then let me know now. Otherwise, we have covered most of the questions we've had on the chat so far. It's been most about demand, supply. Russia is of course, and then of course the dividend capacity is always very interesting these days. With that, Michael, thank you very much for participating. Thank you to the audience for your questions and your participation. See you next time. Thank you.
Thank you.